You wake up in the morning, grab your coffee, and you do exactly what I do. You reach for your phone. It's almost involuntary, right? You thumb open that app. You know the one. The one with the green and red lines. And for a split second you just stare at it. Maybe it's up a little, maybe it's down, but the feeling is always complicated. Because while you're looking at your portfolio, which is maybe, a few $1,000s. Maybe a few tens of thousands if you've been really good, you're seeing these headlines. You're seeing the notifications. Billionaire X just dumped $500 million worth of stock. Tech mogul sitting on record cash reserves. And it makes you stop and think. Wait a minute. Every single financial advisor, every YouTube guru, every podcast I listen to tells me the same thing. Don't keep cash. Cash is trash. Inflation is eating it alive. Put every extra cent into the market. Dollar cost average. Buy the dip. HODL. That's the mantra, right? That's the gospel of modern personal finance. And yet, the very people we are trying to emulate, the titans of industry, the people with the most money to lose, are doing the exact opposite. They are hoarding cash. They are selling assets. They are sitting on piles of liquid capital that, honestly, make no sense if you listen to standard advice. It feels like we're playing a game where the rules are different for different people. And that's frustrating. It feels like you're at a poker table and everyone is telling you to go all in on every hand, but then you look over at the guy who owns the casino and he's just stacking chips. He's not even playing a hand. He's just watching. And you have to ask yourself, does he know something I don't? Or is the game rigged? My name is Jack, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. Honestly, it keeps me up at night sometimes. I'm not just talking about the math of money, compound interest, tax rates, yield curves. That stuff is easy. Any calculator can do that. I'm obsessed with the why. Why do we make the decisions we make when we're scared? Why do rich people panic differently than poor people? And mostly, why is there such a massive disconnect between the advice sold to the middle class and the actual strategies used by the ultra-wealthy? Because here is the uncomfortable truth that we're going to dive into today. The advice that cash is trash is partially true, but it's also a convenient narrative. And the reason rich people hold cash while telling you to invest isn't just about safety. It's about strategy. It's about options. And frankly, it's about a completely different way of viewing the world. Once you understand this perspective, it's going to change how you look at your bank account. It's going to make you feel a little less guilty about not having every penny in the stock market. And it's going to give you a sense of control that you probably haven't felt in a long time. So let's get into it. Let's pull back the curtain on the double standard of wealth. First, we need to address the elephant in the room. Why does everyone tell you to invest everything? Well, for one thing, if you are a financial institution or a financial advisor, or a media company that relies on advertising from financial institutions, you kind of need people to invest. If everyone took their money out of the market tomorrow, the industry would collapse. There is a vested interest in keeping your money in the system. But let's be charitable for a second. Let's assume the advice is coming from a good place. The logic is sound. Over a long period, say 20 or 30 years, the stock market beats inflation. Cash usually loses value because of inflation. So, mathematically, holding cash for 30 years is a losing strategy. But here's the catch: real life doesn't happen in a 30-year straight line. Real life happens in jagged, messy intervals. You lose your job. The roof starts leaking. The market crashes 40% in 3 months. A global pandemic shuts down the economy. For the average person, cash is viewed as a just-in-case fund. For the rich, cash is viewed as ammo. There is a concept in the military and in gaming called opportunity cost. If you spend all your bullets shooting at random squirrels in the woods, and then a bear walks out of the cave, you are in trouble. You have no ammo left for the high-value target. In investing, your ammo is cash. And most people are walking around with empty guns because they followed the advice to be fully invested. Think about the psychology of the wealthy. They aren't trying to squeeze the last 2% of return out of a bull market. They are trying to survive the winter so they can buy the farm when the spring comes. I was reading about this recently, looking at the balance sheets of some of the biggest hedge funds in the world, and the amount of cash they are holding right now is staggering. We're talking billions. Billions of dollars sitting in U.S. treasuries and money market accounts, earning admittedly not a ton of interest, but earning something. Why? Because they know that when the music stops, liquidity is the only thing that matters. Let me tell you a story. It's a bit of a classic, but stick with me because it illustrates the point perfectly. Back in 2008, when the world was melting down, when Lehman Brothers went under and houses were being foreclosed on left and right, most people were panic selling. If you had a 401k, you probably checked it once, saw it was cut in half, and swore to never look at it again. That is the natural human reaction. Fear takes the wheel. But there was a small group of people who weren't panicking. They were waiting. They had dry powder. Dry powder is just a fancy term for cash reserves, but the imagery is helpful. In the old days of naval warfare or even artillery, you couldn't fire a wet cannon. You needed dry gunpowder. If you kept your powder dry, you were ready to fire when the enemy approached. In financial terms, if you keep your powder dry, meaning you hold cash, you are ready to buy when the market crashes. So back to 2008. Who was buying? It was the people with cash. Warren Buffett is famous for this. He wrote an op-ed in the New York Times during the crash saying, "Buy American. I am." He didn't say that because he's a nice guy. He said it because he had been sitting on tens of billions of dollars in cash for years, waiting for exactly that moment. While everyone else was selling their assets for pennies on the dollar to pay their bills, Buffett was there with a wheelbarrow full of cash, buying high-quality companies at a discount. Here is the distinction. The average investor sells when they need money. The wealthy investor buys when they see opportunity. If you are 100% invested in stocks or real estate and a crisis hits, you have two choices. Sell at the bottom, which destroys your wealth, or hold on and hope it comes back. Those are your only two options. You are trapped. But if you have 20% or 30% in cash, you have a third option. You can buy. You can step in and acquire assets that have suddenly gone on sale. This is why rich people tell you to invest but hold cash themselves. They need you to stay in the game to keep the market afloat, but they need to be on the sidelines with a checkbook ready for when things break. It sounds cold when I say it out loud, but it's just smart poker. We also need to talk about what wealth actually is. Because we've been conditioned to look at a number on a screen and call that wealth. You know that feeling when your portfolio is up and you do the mental math? Oh, I'm up 15% this year, I'm basically a genius. You feel richer. You might even spend a little more. You upgrade your car. You book a nicer vacation. This is called the wealth effect. But here's the problem. That number on the screen is vapor. It's not real until you sell it. It's paper wealth. And the rich know the difference between paper wealth and liquid wealth better than anyone. I remember reading about this tech CEO. He sold his company for $100 million. And everyone asked him, "What are you going to buy? A yacht? A private island?" And he said something really profound. He said, "I'm not buying anything. I'm keeping it in cash." People thought he was crazy. "You're losing millions to inflation," they screamed. But he said, when you have $400 million, your goal isn't to make it 500 million. Your goal is to make sure you never have 300 million. See, the utility of money changes as you get richer. For you and me, earning an extra 5% on our savings is meaningful. It might pay for a nice vacation. It changes our quality of life. But for someone worth $10 billion, an extra 5% is $500 million. What does $500 million buy them that $10 billion didn't? Nothing. They have already won the game. So their priority shifts from growth to preservation. And cash is the ultimate preservative. It doesn't crash. It doesn't have a down year. It might lose a little to inflation, yes, but it guarantees you can pay your bills and live your life regardless of what the economy does. I think we often ignore this peace of mind aspect. We obsess over the math of ROI, return on investment, but we ignore the ROI on our sleep. How much is it worth to you to never have to worry about a market crash? To know that if you lose your job tomorrow, you have 5 years of expenses sitting in a high-yield savings account? For a rich person, that peace of mind is worth paying the inflation tax. Now let's address the hypocrisy. Because it really does feel hypocritical. You'll see a billionaire on CNBC telling the retail investors, the everyday folks, to stay the course and buy for the long term, and then 2 days later, you find out through an SEC filing that he just sold 50 million shares. Is he lying? Is he manipulating the market? Honestly, I don't think it's always malicious. Sometimes, yes, sure. But mostly it's a difference in strategy and scale. Think about it like a captain of a massive ocean liner versus a guy on a jet ski. If you're the guy on the jet ski, you can turn on a dime. You can zip in and out of the waves. You can take risks. If you flip, it's bad, but you're the only one who gets wet. The billionaire? They are captaining the QE2. They cannot turn quickly. They cannot move all their money at once without causing the market to move against them. If a billionaire tries to sell 10% of their stock in one day, the price would crash. They'd be hurting themselves. So they have to move slowly. They have to position themselves for a downturn way before it happens. That means holding cash before the crash is even visible to the rest of us. Meanwhile, they tell you to stay invested because, well, for one thing, if everyone tries to get off the ship at once, the ship sinks. They rely on the stability of the masses. The market works because there are millions of us just holding our index funds. If we all decided tomorrow to be like the billionaires and hold cash, the financial system would evaporate. But also, for the average person with a 40-year time horizon, staying the course actually is good advice. Most people panic sell. That's a statistical fact. Most people buy high and sell low. So, the wealthy telling you don't sell is actually protecting you from your own worst instincts. They want you to stay invested so you don't panic and lose your retirement, which stabilizes the markets for them. It's a symbiotic relationship, sort of. A weird, tense one. Let's get practical. I've been throwing around these big numbers, billions, millions, and it can feel distant. Like, okay, Jack, that's great for Warren Buffett, but I have a checking account that dips below $500 sometimes. What does this mean for me? It means you need to rethink your cash strategy. Most financial advice says keep 3 to 6 months of expenses in an emergency fund. That is the standard rule. And honestly, I think that's dangerous. I think it's barely enough. In a world where layoffs happen instantly, where a medical bill can wipe you out, where inflation is volatile, 3 months feels like living on the edge. I want to challenge you to think about holding more cash. I call it the FU fund. You might have heard of this term. It's a stash of cash that is large enough to give you options. It's not just for emergencies like a broken transmission. It's for life pivots. Imagine you hate your job. You have a toxic boss. You dread Monday mornings. If you have a standard 3-month emergency fund, you can't quit. You're stuck. You're a hostage to your paycheck. But what if you had 12 months of expenses in cash? Or 18 months? Suddenly, the dynamic shifts. You can walk into your boss's office and say, you know what? I'm done. You can take 6 months to retrain, start a business, or just breathe. That is the power of cash. It's not just a store of value, it's a store of freedom. I've seen this play out in my own life, honestly. There were times when I was younger and I had almost no savings, and every unexpected bill felt like a disaster. It clouded my thinking. I couldn't focus on creative work or investing because I was just trying to survive. But as I built up my cash reserves, my brain actually changed. I became calmer. I made better decisions because I wasn't operating from a place of scarcity. Rich people have this in abundance. They have so much cash that they can weather any storm. They don't have to work if they don't want to. They don't have to sell assets if they don't want to. That autonomy is the real wealth. Now, the economists and the hardcore spreadsheet guys are going to scream at the screen right now. They're going to say, Jack, you're hurting their returns. You're causing cash drag. Cash drag is a real term. It basically means that by holding cash, which earns less than the stock market, you are dragging down your overall portfolio return. Mathematically, they are 100% correct. If you have 20% in cash earning 4% and 80% in stocks earning 10%, your blended return is lower than if you were 100% in stocks. But here's the thing about math. It doesn't have blood pressure. It doesn't get divorced. It doesn't have panic attacks in the middle of the night. We are not algorithms. We are human beings. And human utility is not a straight line. The utility of having a safe, secure pile of cash is worth more than the theoretical 2% extra return you might get in the stock market. There is a psychological curve called the happiness curve regarding money. Once your basic needs are met and you have a safety net, every extra dollar brings less happiness. But on the flip side, losing money brings more pain than gaining money brings pleasure. This is called loss aversion. We hate losing money twice as much as we like making it. Holding cash protects you from that loss. It acts as a psychological anchor. So, while the spreadsheet says you are losing out on potential gains, your heart and your brain are gaining peace of mind. And when you are calm, you make smarter decisions with the money you do have invested. I've seen so many people during this current high inflation era. They are desperate to beat inflation. They are dumping money into risky crypto projects or meme stocks or speculative real estate deals because they are terrified of their cash losing value. And what happens? They lose the principal. They lose 20%, 30%, 50% of their money trying to avoid losing 3% to inflation. If they had just sat on the cash, sure, they would have lost a tiny bit of purchasing power, but they would still have the capital. They would still be in the game. Losing the principal is the ultimate sin in personal finance. And cash protects your principal. So how do we apply this? How do you structure your finances like the rich, even if you aren't rich yet? You have to move away from thinking of cash as one big pile. Think of your money in buckets. Bucket 1. The spending bucket. This is your checking account. Money for bills, groceries, coffee. Keep this lean. You don't want excess cash sitting here earning 0 interest. Bucket 2. The safety bucket. This is your emergency fund. I want you to aim higher than the standard advice. If you can, try to get to 6 to 12 months of expenses here. Park this in a high-yield savings account, HYSA. It's safe, it's liquid, and it earns decent interest right now. This is your sleep-at-night money. Bucket 3. The opportunity bucket. This is the rich person bucket. This is money you save specifically to buy when the market crashes. When stocks are on sale or when your neighbor has to sell their rental property cheap, you dip into this bucket. Most people skip bucket 3. They go straight from spending to investing. They pour every extra penny into their 401k or brokerage account. But then, when a crash happens, they have no cash to buy the bargains. They have to watch from the sidelines. You need to build bucket 3. It might take a while. It might mean you invest a little less each month so you can build up this cash reserve. But trust me, when the next 2008-style crisis hits and everyone is panic selling, you will be the one writing the offers. You will be the one buying the assets that set you up for the next decade. Let's talk about the hardest part of this strategy. Selling. It feels wrong to sell assets that are going up, right? It feels like you're leaving money on the table. Imagine you bought a stock 5 years ago. It's up 200%. You're loving life. But you think it's getting a little expensive. I should probably take some profits. You sell half. You put it in cash. Next year the stock goes up another 50%. How do you feel? You feel like an idiot? I should have held. I missed out. Now flip the scenario. You hold the stock. It crashes 60%. Now you've lost all that profit and maybe some of your original money. Here is the psychological trick. You will never regret taking a profit too early if you view the cash as a win. Most people view cash as not investing. They view it as doing nothing. But if you shift your mindset to realize that cash is a position, a valid, active investment position, then selling feels like winning. You won the game. You secured the chips. You walked away from the table with the money. The rich do this constantly. They are constantly pruning their portfolios. They are selling assets that have become overvalued and moving that money into cash, waiting for the next opportunity. They are emotionally detached from the idea of missing out. They are obsessed with the idea of keeping what I have. So, why do rich people hold cash and tell others to invest? They hold cash because it is the ultimate weapon. It is freedom. It is insurance. It is ammunition for the next great opportunity. They tell you to invest because they need you to participate in the system, and honestly because for the vast majority of people, the discipline of automated investing is the only thing that will save them from themselves. If you tell the average person market time with cash, they will likely panic at the wrong time or hold cash for 10 years and miss the boat entirely. But you are watching this video. You are thinking about it. You are trying to understand the deeper game. You don't have to be a billionaire to use this strategy. You can start today. Look at your finances. Look at your emergency fund. Is it big enough? Do you have an opportunity fund? Building wealth isn't just about the return on your money. It's about the return on your life. It's about living with less stress. It's about knowing that if the economy collapses tomorrow, you won't be one of the people standing in a breadline. You'll be the one sitting on a pile of dry powder ready to rebuild. Take a breath. Stop checking the app every 5 minutes. Focus on building a fortress of liquidity around your life. And remember, sometimes, the smartest investment move you can make is to do absolutely nothing but hold on to your cash. Thanks for listening, and I'll catch you in the next one.